Well, good morning or good afternoon to everyone, depending on what part of the country you are calling in from. My name is Ginger Bell, and I would like to welcome you to the Uncovering the Benefits of Being an NDC in a Purchase Environment. I would like to introduce you to our panel of experts. My name is Ginger Bell, and I am, my company is Go-To Training. I'm an education specialist, been doing education in the mortgage industry for, 15, 20 years. We've lost track. And excuse me, have a pleasure of having our panel of experts here, Garrett Griffin. And Garrett is the National Non-Delegated Correspondent Manager and really the godfather of NDC. And so I always love having him on these webinars because he has so much great information to share. And then our other panelist, who is Raoul Badde, and he is the area manager for Finance of America. And again, great experience, Raoul. I know you've been at this for a long time and helped a lot of people transition to being broker and now obviously to being an NDC. And so with that, I'm a stats girl, so I like to know, what are the trends we're seeing? And that's really what we're talking about in this webinar today is what are the benefits of being an NDC in the purchase market that we have today? And so, Raoul, we pulled some stats here that I'm going to let you go through that are from Freddie Mac and talk about our year-to-date total home sales. So I'll let you go ahead and take over and kind of explain, what we're looking at in the market today.
Thank you, Ginger, and thanks for hosting this and putting this on again. And thanks to everybody for joining this morning. What we know is that, refis are done in this marketplace. We've got opportunities in front of us that are all purchase-centric, and this NDC platform is a way for you, regardless of investor, to be able to control the life cycle of your loan and really to put your best foot forward in terms of your realtor base, your affinity partners, your borrowers, and maximize your service level when it comes to executing for all those parties. So this is a sheet here, and it really shows you that since, this year to date, we have the total highest home sales, or the highest total home sales, since 2007. So we're 10 years out of the crash. 2007 was the high, and we're near to the same spot as we were in 2007 in terms of unit count for home sales this year. And that's good for all of us that are in the business that have stuck it out, and it's really great in terms of our future opportunities. But of course, where are the new deals coming from? And it's going to be coming from new build, right? We know that existing home sales, or those homes that have been built and are trading between private parties, are limited. There's not going to be a whole lot of growth in that category year over year. But new build, and another area where as an NDC you get more control in approaching the builder and winning, builder business. New build is where there's going to be growth going forward. And so we're expecting a couple percentage point gain, 17 to 18 from a total count. And just again, this NDC channel is the easiest and fastest way for you to be able to execute at the highest level for all of those parties.
Right, and that's really the key too. And if you're looking at, getting into the purchase business, which so many are, especially, building those brands with your real estate partners, there are many benefits to being a non-delegated correspondent in the market that we're at today. And so, Garrett, I'm going to let you talk about some of those benefits, beginning just kind of the overall benefits, and then we'll kind of drill down into some benefits, especially like the pricing benefit.
Well, Ginger, I've been blessed to have been in the non-delegated correspondent channel for slightly over 20 years now. And the recurring theme that I hear from those that have transitioned successfully and love it is control. As a non-delegated correspondent, you're the lender of record. So you're in complete control of the initial loan estimate and what is on the loan estimate. So as a non-del, you can disclose as much or as little as you choose to. And of course, that information will go directly to the closing disclosure as well. So as a non-delegated correspondent, you have the ability, if you so choose, to disclose a no lender fee loan. Non-delegated correspondents because they're selling that loan in the secondary market, and we'll get into this in a lot more detail in a minute, enjoy a secondary market transaction exemption from fee disclosure. And so the ability to control the LE, have it match the correspondent CD, and additionally, non-delegated correspondents have the ability to use the AMC of their choice. So if they have the ability to get the LE up front and quickly, get an intent to proceed, order an appraisal from the AMC of their choice, that's going to translate to getting that loan approved more quickly and closed on time. You know, our non-delegated correspondents also enjoy the opportunity to brand themselves as a mortgage banker. The fact that they've got a lower net worth than, say, a delegated seller doesn't matter, because mechanically the loan closes and funds in the exact same mechanism as even the largest correspondent lenders. So, you know, overall, in making this transition and letting someone else take the credit risk, hence the term non-delegated, where the investor is underwriting the loan, they enjoy all the benefits of even the largest lenders are able to brand themselves as a direct lender and compete for more business.
Absolutely. Now, one of the things you touched on was pricing. So let's go into that a little more in detail, because it really is one of the greatest benefits of being an NDC.
Well, so today, as a mortgage broker, you can be paid one of two ways: lender paid or borrower paid. The vast majority choose lender paid. Well, obviously, if you're trying to bring in a purchase loan, you're bound by what your lender paid comp is with your particular investor. So if you had an example, say you had a 2 3/4 comp plan, and all of a sudden you're getting a 760 high val loan, it may be very difficult for you to compete. As a non-delegated correspondent, you don't have a compensation plan with the investor. You're able to price each individual loan on its own merit to compete and bring that deal in. This gives you a tremendous amount of flexibility in between what you want to disclose in fees and how you want to price a loan to win more purchase loans. Additionally, a non-delegated correspondent has the ability to be paid up front, so whatever fees they elect to charge, and they can charge at closing, plus they can earn service release premium or above par pricing at loan purchase. So a non-delegated correspondent has the ability to be paid by both the borrower and the lender in terms of a service release premium. You know, additionally, there's a tremendous amount of flexibility in terms of structuring loans mechanically, and again, being able to compete for every possible purchase loan in the marketplace.
Right. So in addition to that, as far as the pricing benefit, there are a lot of branding benefits, and that's important, especially when you're looking at building those relationships with real estate agents, right?
Absolutely.
You know, yeah, the greatest part about this being in a non-delegated and going out to your affinity base and so, you know, and your affinity partners, your borrower base and so forth, is really that when your transaction is completely your own, you're owning the entire life cycle of the loan from origination to funding. So there isn't any element outside of maybe an underwriting decision and, you know, conditions that need to be cleared, where it isn't your own information as a company from the very beginning to the very end of the loan. So even when the loan documents are printed, it's got your company name on there. And it really gives you the power of presenting out to all of the parties in the transaction as the lender. And it solidifies who you are with your borrower base as well as your affinity partners out there. So that brand strengthening, you know, that it equivocates to strengthening your brand from again, start to finish. You're not then subject to, XYZ investor or, you know, wholesale lender making a decision or sending out disclosures perhaps incorrectly, or having to then reach out to them independently to make some corrections. You're in control of the loan estimate. You're in control of the CICs and the loan estimates after that, all the way through the CD. And then we'll cover further down the road, you know, how some of those steps are handled. But again, we're going to assist you at Finance of America from the very beginning to the very end to make sure that you're fully compliant. More important, though, is this whole concept of building the brand forward out to the folks that you work with, and really, again, being the lender to that group and not having them see you as just an in-between or arbiter of information, which is extremely empowering.
Well, and I like the fact that you talked about building the relationship out, Raul. And that's really, when you're starting a company and you're saying, hey, or if you're a broker and you say, I want to, be able to compete on the same brand, as far as having my own brand, and the disclosures are a big part of that, and building that out for the future is really part of the whole plan that they should have in becoming an NDC, right?
As Raoul said, right,
Absolutely.
I think one of the biggest things is you're able to tell your customers, with the exception of underwriting, that you literally you're empowered at every step of the way and being in direct control as a lender in terms of your choices and alternatives.
Right.
Raoul, what were you saying?
That's exactly it. I mean, it's really about the control and not having your consumer out there seeing you as a potential go-between, where they might perceptively feel that you're not in control of some element of the transaction. Whereas by owning the life cycle from beginning to end, you're going to the consumer, you're going to your affinity partners and saying, absolutely, here's how it can go. And then it gives you, regardless of investor whom you're working with, obviously we want you to work with Finance of America first, but at the end of the day, if you choose a different investor, you're controlling the CD, right? So you're not subject to their brokered CD processes anymore. And even with the loan document piece, which we'll cover too, there's an element there that you can add some service level enhancements to your consumers as well as to your realtors. So
right,
lots of opportunity around how your performance and how you can enhance your performance to your marketplace and meeting and exceeding expectations out there.
Right, and it ties into really all the conversation that we're having right now is in today's environment, and I know, Garrett, you talk a lot about this, is increasing that competitiveness to be able to compete in the environment we're in right now with both the pricing and the speed and the consistency, right?
Yeah, I mean, ultimately, there's some great mortgage brokers, and it's a phenomenal channel for some people. I'm not here to in any way, shape, or form disparage being a mortgage broker, but as a non-delegated correspondent, as Raoul and I have been sharing, the disclosures, the LE is prepared in your name and sent directly to the customer. The intent to proceed can be signed immediately by the customer. You're able to order the appraisal in your name as the lender from the AMC of your choice. The closing disclosure is disclosed in your name, and you're choosing the source and method by which you want it prepared. And the same applies to the closing documents. They're prepared in your name as the lender, and you're controlling how those closing documents are prepared. The money, the funding source comes from your warehouse line, right? And ultimately, the loan is quickly purchased, and then you're paid. So if you're able to control how you price the loan, how you can structure a loan, the fees you charge, and the timing on the disclosures and getting into underwriting, I would submit that that's a very powerful value proposition in competing for more purchase business. Raoul, what do you think?
Absolutely, and gives you the opportunity as well to leverage your position in the marketplace with, as we discussed earlier, builders being, one of the primary sources, primary drivers of new purchase opportunity from a volume standpoint. I'm in Northern California, and there's a segment in our market where for many, many years it was ineligible for building. And in 2016, some laws got passed and updated, and some maps got updated, and now there's 10,500 units going to be constructed in the next 3 years out there. And so being in that marketplace as an NDC, they'll be able to, the brokers that are out there will be able to present out to the builders as lenders and to be able to structure some potential opportunities with those builders, from a compliant referral standpoint to being an in-house, right? As opposed to being subjected to the broker paid, lender paid compensation restrictions that come up, and some of the opportunities that are perceptively lost, with the in-house builder, even though we know most in-house builders aren't priced as competitively as most brokers. And as an NDC, you're typically on the street pricing to a broker pricing template or rate table, which still keeps you tremendously competitive. There's opportunity, as Garrett said, to control, but for the most part, what I see, especially on the smaller, 50 and below employee NDCs is they're operating as basically very, very large brokers, and they're priced that way as well. So they're still extremely competitive to the retail space, and being able to present as a lender to a builder, there's just not a way to say that there isn't an opportunity there. So big time, big time business opportunities, especially with where's the volume coming from in a purchase environment go forward.
Exactly. So, and we're getting a question in, and before we move on, Greg is asking if we could go over specific scenarios so we can see the difference in pricing between FAM wholesale and FAM NDC. And Garrett, I know we've gone through that, and we actually in FAMU we have very specific examples on those. So Greg, you might want to hop in there and go through some of those. But Garrett, do you want to just kind of lightly touch on that real quick?
Well, on the non-delegated correspondent side, the only products that are non-DLC are our agency direct, essentially no overlay products. And those are priced at the same as our best execution. So there's a price lift for doing that. We want our non-delegated correspondents to have what I call a predictable and repeatable loan approval process. One of Finance of America's unique strengths is in a world of automated underwriting, if you put accurate information in there, what over a 99% chance whether the loan's going to be approved. So really it comes down to what conditions are being asked for and how quickly can you get those cleared, or if you have to provide an alternative. And all of our underwriters take phone calls directly from our customers. So our NDCs, we try to have NDC specialized underwriters that our customers can build relationships with. And, and besides the fact that they're getting a little sharper price, agency direct products and deal directly with the underwriters, they'll know they're not going to see any overlays, right? So once they run the loan through either desktop underwriter or loan prospector, they should expect conditions to follow pretty much with those findings, get those cleared quickly, get a clear to close, and get that loan to closing on time so everyone gets paid.
Excellent. Thank you. And Greg, again, for examples on that, get with Garrett, get with Raoul. I'll shoot your information over to them, and they can go through those examples with you and really the benefits to it. So let's move on to talking about the difference between a non-delegated correspondent and the traditional correspondent. So looking at licensing requirements, net worth, things like that, Garrett, what are the primary differences?
The net worth requirement, the minimum net worth requirement at Finance of America is a $75,000 unaudited net worth. The reason that we chose the $75,000 is that's also the minimum net worth from several of our most strategic partners in the warehouse lending space. They also use an unaudited net worth. So essentially, as long as your financial support $75,000, that qualifies you to make application to get approved with one of our warehouse partners, and that would qualify you to get approved with Finance of America. Licensing, it does vary by state. In California, as an example, to be a non-delegated correspondent, there is no additional layering or net worth requirements. That's the same in Texas. There are some states nationally that do have higher net worth, and we can put you together with, if you have specific questions, I'll be happy to refer you to one of our strategic partners, First Funding. That's who I recommend for all new non-delegated correspondents in terms of a warehouse provider, and they can get you specific state licensing requirements.
Very good. So let's talk about now the processes and the programs and the difference between that's available for an NDC. So starting with submission, then talking briefly about underwriting and some of the loan programs.
Raoul, why don't you take this one?
So the process isn't any different, for you outside of the loan estimate being issued on your end as the lender. So you'll own the initial intent ITP or intent to proceed. You'll own the loan estimate, and then from there you submit the loan through into underwriting just as you would any other brokered loan. The programs that are available, again, as Garrett mentioned, is straight to agency, conventional USDA, VA, FHA if you have your Title II, which is again something that we're happy to assist you with. Requires $1 million net worth, and then now with Finance of America, we've increased our product suite to also include our Revealed Jumbo Series, which is a 6-product jumbo series out there that covers the gamut from 90 LTV, borrower paid MI up to $1.5 million, or even a 49 DTI or a 660 FICO on a jumbo that you could fund internally. So having some jumbo on your own, on your own business line is, again, just one more way that you can enhance your service levels, your product offering to your borrowers out there, and really, capture additional opportunities.
So looking at that, and I know we had some questions on pricing, really the comp agreement then between the wholesale and the non-delegated correspondent, what are the primary differences between that?
Well, in a wholesale transaction, there's a compensation agreement between the lender, the wholesaler, and the mortgage origination company. And then, of course, they're going to have a further comp agreement between the mortgage origination company and the loan officer. As a non-delegated correspondent, there is no compensation agreement between us, the investor. We're not the lender, we're the investor, the mortgage originator, and then there's a comp agreement up between the mortgage originator and his loan officer. And not having that compensation agreement is just, that's one of the, I can't emphasize how important that is, because in the wholesale world, the broker world, you're set in that comp plan. And I'm sure everyone's had the t-shirt where you've got a set comp plan and all of a sudden a borrower comes back and shops you and you can't lower the fee. The only option you've got is to try to take that loan borrower paid, and that's a whipping to do that. As a non-delegated correspondent, you can always lower your comp for any particular deal and continue to compete and close your loan. So that's one of the most important paradigms to understand in the NDC channel, is that no compensation agreement between the investor and the originator.
So with that,
additionally,
if there's
on the comp piece.
Oh, go ahead, Raoul. Sorry.
On the comp piece, it gives you an opportunity for recruitment as well, right? Because on the broker channel, at times you can encounter, issues in terms of how you're set up with certain investors, and if you're actively recruiting a specific loan officer that might have a relationship with a specific investor, it gives you some additional opportunity there by not having to be as concerned about the comp agreement that you have set with that specific investor. So there's a pickup there in terms of recruitment as well when you're out on the street, bringing in new hires for your business.
Yeah.
The most successful loan originators are very aware of the strategic advantages of working for a direct lender as opposed to a mortgage broker. Again, there's great mortgage brokers. I am not disparaging that channel. But if you're an originator and you have so much additional flexibility in structuring and the ability to structure a loan, price a loan, and compete for a loan, most of them like that alternative and that flexibility and the opportunity for additional business.
Well, especially for originators who have worked under a correspondent channel, for them, that's just what they're used to. So it allows them to stay in that capacity as well. Let's move on and talk about when do they get paid? Because that's always the first question. Okay, as an NDC, when do I get paid? So it's different, and they have to be aware of like the interest, the rate lock, and things like that. So how does that work, Garrett?
Well, so as a broker, you're basically being paid for arranging a loan. The wholesale lender is the lender of record. The loan closes in their name, their money disperses, and you're paid a fee for arranging that loan, which the borrowers agree to pay you at the closing table. As a non-delegated correspondent, you don't get paid at the closing table. You get paid when the loan is actually purchased. So one of the strategic advantages with Finance of America is we have one of the best loan purchase teams in the industry. And we purchase loans in an average of about 3 business days or less. So the loan effectively closes at escrow or settlement, depending on how you do business. I live in a wet funding state. Then that closing package is uploaded to Finance of America. The warehouse bank then forwards the original note, what's called a Bailey letter, which is their security. We review those requirements. If everything's met, then we basically purchase the loan, and that money is wired to the warehouse bank, and then the customer has access to it.
Excellent. And as a non-delegated, we often get this question: is it necessary to add additional staff?
And the
No.
answer to that really is no. I mean, your processing team as set up today can handle all this. And with the FAM Express Plus tools that we give you, we're going to take care of everything from CD, all the way through fulfillment processing. So Finance of America, again, gives you a strategic, competitive advantage out there, and alleviating the need for additional staff and pricing it into the loan effectively through a fee. So it's, again, no additional staff is needed out there for you. If you start to grow your business and exceed the abilities of Finance of America, potentially, now you're starting to do 20, 30 units a month, and you're looking to expedite your time. I mean, that might be the opportunity to look at getting a closer into your office, having someone that can help you draw loan documents and issue and fund loans. But until that time that you've grown the business that large, there's really no need to add any additional staff. I would argue, I mean, you'd want to do, at least in this environment, you'd want at least 30 units a month funded before you even go through the process of adding staff. And because, like we covered earlier, there's no change to the submission cycle. It doesn't, and the packaging process doesn't change, in terms of getting it over to us for underwriting. There's limited variances in terms of additional workflow on your side.
Right. And that's a nice thing, too, in the environment we're in, is to be able to give that ebb and flow based on volume without having to, hire staff for that.
This program has been carefully and meticulously put together to allow customers the opportunity to enter into it without having to hire any additional full-time employees, right? And so you have the ability to outsource on what I call a variable cost basis, which is a fancy way of saying you pay for your services loan by loan, and it can be passed directly through to the borrower. So if you follow the methodology, just as Raoul said, the next evolution for a non-delegated correspondent is once they get to that 25, 30 loans a month, they might at that point to hire a closer, and that just takes them to the next level, a little more control. But again, you're doing that at a point where it's more than profitable to make that decision.
Right. So we have a question in. Greg is asking, if we lock a loan with a borrower and lock it with the investor, but the deal falls through, do we owe money to the investor?
What Greg's referring to is what's called a mandatory lock. Finance of America only offers best efforts locks, which means you're making a lock and you're locking a loan with the intention of the best efforts delivery. A mandatory lock is different. There are some investors that will offer that to their non-delegated. It's very rare, and then you have what is called a pair-off fee associated with a mandatory lock that's not delivered. But again, at Finance of America, we do not offer mandatory locks. It's best efforts delivery. So no, in the event of a loan that you locked that was unable to be delivered, you would not owe Finance of America money.
Excellent. Thank you. So let's talk about requirements as far as becoming an NDC. And you kind of touched on this already, Garrett. But the licensing, the net worth, errors and omission, those are the primary requirements, right?
Again, we are other than a $75,000 net worth, right? And we have that net worth because our strategic warehouse partners are also at that same net worth. Now, again, licensing varies by state. I know for a fact in California, you do not need a special license. I know in Texas and many other states, you do not. And in some states, depending on the licensing, it may have a slightly higher net worth. It just depends on the state licensing requirement. Errors and omission insurance, while we require it, what we require, every warehouse facility is going to require errors and omission and fidelity bond insurance. And that's basically, we're mirroring the warehouse line's minimum standards for approval. So errors and omissions insurance is not hugely expensive. It's a great idea, by the way, for everyone to carry it. And it is a requirement for becoming a non-delegated correspondent. But that's typically, it's strictly required by the warehouse bank that's offering the line of credit to the customer.
Right. And there's great resources to be able to find those as well. So the main thing is to start with what are the state requirements? So what does your state require as far as anything, any differences? And then once you look at that, then you can look at, okay, any additional licensing, net worth, things like that. We're going to talk a little bit about FAM's requirements in a minute. And I'm so excited about being able to do this because this is always one of the biggest questions that people have when they're saying, okay, I'm going to go from being a broker to being an NDC, and what do I need to do to make sure that I get my disclosures out, I order my docs, especially in the closing process. And so we're going to talk about, and we're doing a webinar for this next week, which I talked about in the beginning, a brand new product that FAM is rolling out called FAM Express and Express Plus. And what it provides is your lender prepared closing documents, one-stop shopping for your underwriting and documents, very competitive fee structure. There's support, document upload, everything is contained, and it's a direct system that integrates all of your closing documents for accuracy. And it provides you with that ability to build that brand knowing that you have that success behind you of FAM and that they have that expertise to be able to deliver these CDs and the documents and help you through the entire process. So Garrett, I'll let you give just a quick little overview of it. We're going to get into this next week more in depth, but just the 30,000 foot view. What does FAM Express offer?
Well, first off, while it's brand new to our seminar series, FAM Express is not brand new. I don't want anyone to think that they'd be a guinea pig coming into the process. We've been successfully offering this now with several customers for several months.
Right.
The number one thing I was asked for and by my customers ongoing at large was a lender-prepared closing document solution. And after much research and a tremendous amount of strategic initiative, we put together FAM Express. And so FAM Express is an option that lets the customer order either just the CD and closing documents, or FAM Express Plus is the CD, closing docs, and full fulfillment. So basically, once a loan is in an approved status with an appraisal, the client can order the CD directly from the FAM Express link in our system. One of the nice things is because we already have the vast majority of supporting documents in our package, our team of experts will go into our system and take all of the appropriate necessary supporting documents so they do not have to be re-uploaded to create that order. And then we prepare a CD, get it balanced, and give that back to the lender to send to their borrower with closing docs shortly to follow. FAM Express Plus takes that to the next level, where we actually will prepare the wire request, authorize disbursement, and then we will deliver and handle the post-purchase closing coordination. So basically, it's all-in-one shopping for a full fulfillment option with FAM Express Plus.
Well, and to the point of, this is a newer product that is for NDCs, created for NDCs that are just getting started, so that they're going to have your expertise and your team and your staff guiding them through, looking at that, making sure everything's in there, especially from the delivery and the purchasing side of it. And so that's fantastic. So and register for it next week. We're going to get into this in a lot more detail as far as how it works and what it covers and everything. So let's move on and talk about getting started with FAM as an NDC. So what are the requirements? You talked a little bit about this, Garrett, but FAM has requirements in addition to your state requirements.
Well, as you put up here, we're going to get a $75,000 net worth, errors and omission insurance with a minimum coverage of $3 million. Have a traditional warehouse facility with a minimum line amount of $1 million. Again, that's where that $75,000 minimum audit comes in. That's the same requirement for most of the warehouse banks that are our strategic partners. We do ask someone to have strong investor scorecards. If we know the customer very well, we can sometimes write an AE recommendation to accommodate that, and then be properly licensed. Additionally, we're going to want someone to give us their error policies and procedures if they want to use the AMC of their choice, which is basically simple document that outlines in writing that you're going to use an error-compliant AMC. So if you provide that information to us, we can get you approved as a non-delegated correspondent. Step one is you have to reach out to one of our strategic warehouse partners and get a warehouse line. It's kind of a catch-22. We can't approve you without a warehouse line, that process can be as quick as 30 days or less, depending on the strategic partner.
Right. And just kind of back up, the errors and omissions insurance is a minimum coverage of $300,000?
Correct.
Okay, perfect. So we have some easy steps to go through for getting started with FAM. And the first step is to get in touch with you or Raoul, obviously, but really starting at the FAM wholesale site, right?
Yeah, absolutely. Go to famwholesale.com, click on becoming a broker or non-delegated correspondent, fill out the request form, and we will have a sales professional contact you immediately. Or you can certainly email myself or Raoul directly, and we can refer you to that person. Or if you have any direct questions about becoming a non-delegated correspondent in general, email Raoul or myself, and we would be more than happy. It would be our distinct privilege to give you more specific information as it applies just for you.
And if someone is already have an agreement with you as a broker and they want to become an NDC, then that's the NDC addendum and agreement. So it's not
again, if they, assuming they already had a warehouse line, they would just need the NDC addendum and agreement. If they did not have a warehouse line and were a broker with us, same process. They would have to get approved for a warehouse facility and give us the NDC addendum and agreement. And that NDC addendum and agreement has a checklist of all of our requirements as a non-delegated correspondent.
Absolutely. So any other questions you have to our listeners, type them in there and we can address those. If you do have questions that come up that you think of, oh my gosh, I didn't think about this, you can contact Garrett, or you can contact your Finance of America account executive or Raoul. But there's so many advantages to working with Finance of America. So Garrett, I'm going to let you really talk about the advantages of getting started as an NDC with FAM and the support that you offer.
You know, as I kind of shared earlier, right, NDC is a business channel, a vibrant business channel that we support. We've got dedicated team members. We have one of the most phenomenal loan purchase groups in the country. We have specific underwriters that are trained on NDC loans. And the reason I emphasize that is obviously the conditions that would come out are different from an NDC because it's a lender closing in their name as a wholesale loan. So we have experienced NDC underwriters that you're able to communicate directly with to get clarity on conditions. We want you to have a predictable and repeatable loan approval process. It's a phenomenal customer experience. It's super easy to upload your loan file or conditions directly to us. And, you know, we're set up to underwrite with clarity in mind for a quick loan purchase. We're not going to, we do the very best we can to never leave you hanging with a condition at closing that could affect the purchasability of that loan. So we're mindful that the goal of the non-delegated correspondent is to function as a lender, but have a partner that's watching out for their best interest in terms of making it easy to get that loan purchased at the end of the transaction.